I'm not saying we're bouncing to 2021. It's going to take 20 years to experience that moment again. It will happen again. It's every 20 years, right? But 2024 will be rich with IPOs, and it will be a good year with solid multiples.
Jason, I am so excited for this. I always so enjoy our chat. So thank you so much for joining me today, my friend.
Thanks for having me back, Harry. It's always a pleasure.
Now, you know the normal start of like, how did you get into venture malarkey? I wanted to start with, if you could call yourself up the night before you started as a venture investor and give yourself a piece or two of advice, what advice would you give yourself knowing all you do now?
Yeah, well, it's an interesting question. The first one I tell everyone that's a new manager, especially anyone above the analyst level. And what I was told when I went into venture, and I think you might have been told the same thing, was don't worry about doing a deal your first year. Don't worry about doing a deal. I'm not talking about an angel check for 10K or 50K. I'm talking about don't worry about writing an enormous check. And this is what the traditional GPs tell you, because the last thing they want you to do is to meet with 28 pretty good companies and burn the fund, right? They know how rare the outliers are, right? And so this is the advice I got: don't invest your first year. And I did 5 real unicorns in my first 13 months, right? I did Pipedrive, which exited for like 1.25 billion. And then Algolia was my second. That's worth 2.5 billion. It will IPO next year. I did TalkDesk, worth 10 billion. I did Parklet Greenhouse, which will IPO next year. They're at 200 million. And I did Salesloft, which sold for 2.5 billion of cash. Those are my first 5 deals. And it's interesting how it happened, but I tell everyone, if you have something, if you have a hot hand, if you have a brand like a 20 VC or anything behind you, or a great network, if you came out of Datadog or Stripe or wherever, MongoDB, and you have a network, go do those deals. Like, you may not know venture, but that's what the other guys are for, right? They will teach you ownership. They will teach you some discretion to some extent, but leverage it. It's interesting how many great VCs had a great investment their first 6 or 12 months. The first friend I had that became a VC was David Hornick, right? Who's now at Lobby, was at August. And he tells a story how this first deal, he like blew 10 million, which back in the day was like a career ender, right? As a kid going into venture. But his second was Splunk. I think his second one was PayCycle, which then he did Bill, right? Which was Renee's second one. So the first one exited for 100. The second one's worth 20 billion. I think Splunk was his third. And he did those all the first year in a downturn, in a massive downturn. And you talked to a lot more VCs than I can, but I wouldn't be surprised if a lot of the best VCs had at least one big winner their first 12 months. And so that canonical advice is great for the fund. Trust me, it's great for the fund. Don't blow it all, kid, right? Just because you are a SVP of engineering at New Relic does not mean you know how to find a great seed investment. That is true. And I tell it to everybody, and I say to them also, because even if it's not perfect for the fund, it's great for you to get into a winner your first year. That winner lasts forever. The great thing about venture is your winners last, you can talk about them for a decade. You can literally, and so the earlier you get a winner, and a winner really being like the person on the board, the first investor, like an iconic winner where the founders will back you, the earlier you get in your career, you could probably raise 3 funds on the back of that, even if all the rest of your investments are dogs, right? So you only live once. So that's the main advice. That's the number one, which we could do. And the second one is the opposite, which is I tell folks, and unless you're starting your own fund really from scratch, right? And even you didn't do that, Harry. You had a stint at another fund, right, before you started. If you're joining someone else's fund, the other advice I give folks is be zen, because it's not yours. This is the biggest mistake I made. The biggest good thing I did was ignore the advice, and I did all those deals immediately, right? All of them, right? Now I'm a 10x investor for life. Like, that was worth it, right? But I wasn't zen enough about joining someone else's fund and all the friction. It's not yours, right? It's not yours. Whether you join someone else's fund at 15 or 50, you're an apprentice. You're not running the management company. You probably don't know what the management company is. You don't know how the economics work. They used to say it's your second startup, you make money. And maybe your second stint in venture, you make money.
Can I ask you, when you look back on your first 5,
yeah,
has anything changed from that style of investing? And to what extent do you think that was luck? I mean, that 5 in a row.
It's not, obviously it's not luck, Harry. I mean, like, I don't think I'm any Keith Rabois or Vinod Khosla, but it can't be luck if it's 5 for 5, can it?
Exactly. So what would you put it down to?
First of all, one thing, which is only a small amount of it, but is having time, right? And I remember I bumped into Byron Dieter at the airport when I just started investing. I'd known Byron because he gave me a term sheet as a founder, right, at running Bessemer's Cloud Practice. And he's like, I'm jealous of you. I mean, what do you mean you're jealous of me, Byron? He's like, you actually have time. all you have to do is work on new investments. Not only do you not have boards or down rounds or workouts to deal with, you just don't have the emotional baggage going into venture as in a venture fund, right? All you have to do is hunt and meet founders, right? I think that's underestimated in the industry, right? And ultimately, I mean, you have large teams working under you in many ways, Harry. You need that in venture to scale. You can't be this rogue artist going out and hunting deals your whole career. A few people do that, right? But it's rare for a variety of reasons. Not only do we get tired and age out of our networks, but we have too much to manage, right? We have too many investments under them, right? And I only half knew this, but really sticking to your sweet spot is core, right? And I knew I only wanted to do a certain type of founder at a certain stage doing products I intuitively understood, right? I intuitively understood search. I intuitively understood contact center. I intuitively understood ATS. I intuitively understood, I thought, how to build a better version of Salesforce. And so I only did this narrow overlap of things I already understood before the meeting and were exactly in my sweet spot, right? And if I did that with founders that were better than me with good growth, like 100% hit rate, right?
Totally. I think what's rare there is not many people actually know what is their type of deal. It's a very precise art to know exactly what is a Jason Lemkin type of deal. And many investors I know 10 years in still don't have that clarity on what is their type of deal.
Yeah, and if you don't, you also can get into trouble in terms of how much you deploy into what, right? If you know your type of deal, you're probably going to almost inherently get your risk profile right? I know my valuation ceiling, and I know the different types of valuations I'll do for different companies, and so I can only lose so much. It just de-stresses things a little bit.
Can you give me an example of that, just so I understand that? You said your risk profile on the valuation side and how that differs. Is that because outcome scenario planning for contact center software might be a very different outcome scenario plan for Salesforce competitor?
No, I don't do outcome planning. I remember when I invested in TalkDesk, the best comp was Five9, which is public today. They were worth a stunning $150 million as a public company. So the comp was horrific, right? It was terrible. We can look at, I think Five9's worth $6 billion today, and on paper, TalkDesk is worth $10 billion. So you have to be careful with comps as markets change, right? Some of it you have to back into your fund size, right? What's 2% of the fund per check? And so for me, I learned there were two types of investments I wanted to make, like traditional seed, where you had at least a little bit of revenue, at least 10 customers, 15 customers, 20 customers. And then I wanted to do what used to be called late seed, which is hard for me because it's been obliterated. But late seed was sort of approaching $1 million in revenue, right? With real traction. No management team, like a lot, but getting to $1 million in revenue. And I wanted to do one of each. So I did, TalkDesk at $1 million, but Algolia at 100,000, right? In terms of annualized revenue, right? And I did Pipedrive at $1 million. I kind of ping pong back and forth between the two. And I was able to write smaller checks to try to get at least 10% ownership in the others. And then the late seed ones, I would write up to a $4 to $5 million check to get double-digit ownerships. And that, if you're able to invest at $1 million and the founders are great, you'll never lose money. If the founders are great at $1 million in revenue, the problem is that's become a Series A, B deal even today. So that part of my model has partially been obliterated, which is the hardest part for me. But it still happens with outsiders. It's just impossible with insiders.
I had a 600K ARR deal done at 750 million.
Yeah, so that's tough for my fund size. It's hard because let's do the math. How much would I have to invest to get 10%? I'd have to invest 70 million. The fund's 68. Let's see. It's tough.
It's a tricky one to get the maths around. That's one where your LPs might question you. But no, I totally
That's
agree.
why I actually don't. I know a lot of folks go back and forth. That's why, honestly, Harry, within a range, I simply don't care about valuation. I want to have a fair valuation where I can hit the ownership target, and I don't care. All these people on Twitter grouching that their deals are at 8.4 pre instead of 6.2. I mean, who cares, man? Who cares?
That I get entirely, but I do absolutely think that actually when you're moving from 12 to 25, that difference is very important. And actually, if your fund size is constrained to an extent like yours and mine are, actually it does make a difference if you want to hit that 10% ownership target, because that's gone from 1.2 to 2.5, and then your level of diversification will be half.
In any segment of the market, folks that are doing better will command a higher valuation typically, right? The last thing you want to do is, wow, this company, 700 pre is tough, right? But I think the last thing you want to do is pass on a $30 million post deal where everything's great, right? It's the last thing you want to do, right? It's the last thing you want to do.
My challenge is though, Jason, most of the time when they're 20 or 25, not 30, that's kind of just a little bit, it's not that they're going great or badly, they're just starting. So...
Well, yeah, for me, honestly, Harry, I do it all by email and I don't take the meeting. So I hear you. If you go to SaaStrFund.com, you will never see a more descriptive website. Here are the exact ranges I do. If you scroll through it, you'll see the valuation ranges. You'll see the ownership. Like, it's like just, and I literally got an email from a great CMO starting a company yesterday. He's like, look, there's no chance, right? I'm like, no, there's no, I love you, but no. I read your website and there's no, I still caught up with him. The other tough thing in today's world, right, and it probably segues into the topic you want to talk about is, there's no downturn in seed whatsoever, no matter what. Twitter's wrong. Seed is more vibrant than ever, and we can talk about why. And seed is also split up more than ever. More and more folks are taking more and more tiny checks, right? That genie's not going back in the bottle, right? But it's bad for seed investors, right? The last thing, people like you, Harry, and they may not like me, but they want my help. Maybe they like me. And so I do get a lot of offers to buy 1 or 2% of a startup or $100,000. And the founders don't understand. They don't understand. I'm like, it's great. And I will do 1 or 2 of these a year. Typically for outsiders or others for specific reasons, but not to make money.
Why is that splintering of rounds happening? Because if you read a lot of tweets, if you read a lot of coverage, it says that this is the end of party round days and we're back to the conviction-led, larger check investor round. Why is that wrong? And why is the splintering? It's
completely wrong because there are so many founders and executives that have made tens of millions, hundreds of millions or more money that enjoy seed investing. Right. And many have their own funds now. Even the founder of Freshworks just announced his second fund. Right. Jack Altman, who I love from Lattice, has multiple funds. And those are institutional funds. Those are real venture funds. Forget about that. What about the folks that there's just so much liquidity that happened, especially in 2020 and 2021. And what do you want to do? The San Francisco Peninsula is so boring. Like, what are you going to do? How many hikes can you go on the dish? Eventually, the only thing to do is angel investing in the Bay Area. If you're in the city, you can, throw rocks at whatever. You can make fun of San Francisco. But if you're on the peninsula, it is the most boring place I've ever lived. The only fun thing to do is angel investing. Let's say you've made $100 million, Harry. And I know, and this would have been crazy to say when we first met, but there's so many founders made $100 million and so many executives made 20 million or 30 million and have good lives, and they want to put 10 or 20% of that into angel investing. If you're connected, and there's a huge difference today between insiders and outsiders. It's more visceral than ever. But if you're an insider in Palo Alto with these bored, rich tech people, you can put together a $3 million seed round with 30 people. I was literally on a Zoom yesterday with the founder. And he's like, I'm struggling. He's like, why are you struggling? He's like, well, I have no customers, no product yet, and no traction. And but he's very good, very charismatic, connected. He's like, and all my friends told me I need a lead investor for my seed round. I'm like, well, if I were you, I would take 30 checks from tech people. He's, I already have that. I already have $3 million for that. I'm like, close it. He's like, you're the first person that told me this. Like, I've been waiting 2 months to get 20 VC or Coastal Ventures on my cap table. But you already have $3 million from rich tech people. Close it this week, you fool. Pick a fair price and do it. Why would you not get going with your life as a founder, right? And the other thing is the A investor. He's like, well, the A investors are going to be sensitive if it's only angels. The A investors don't care. They just want a rocket ship. The A investors don't care if it was Stebbings, Lemkin Ventures that funded you. They don't care. They don't care.
So you would advise founders to take those splintered rounds if they're on the table and ready to go?
Rather than struggle? Yes, of course, rather than struggle. If I have an option, if I've got 20 VC will give me a $2 million check and I can get $1 million from friends, or I get $3 million from friends, of course, I'd probably take the institutional money plus $1 million, right? That's a great, then that's the best of both worlds. But would I struggle to find the institutional money when I can get $3 million? Like that's a Twitter mistake. That's a rookie error. Every week there's more liquid tech folks that want to invest in seed, either directly or creating funds, right? And the emerging manager boom of 2021 may be over, right? Folks without a track record may be over, but the folks that can assemble their own fund or their own resources is just getting going. It's just getting going.
So I totally get you. I think we're also, so that's like increase in supply from operators who have liquidity.
Massive supply.
I think, yeah. And then we're also seeing increase in supply from multi-stage funds who don't want to deploy Series A's and B's because they're larger checks, but they still need to be in market and investing.
For now, that'll fade.
Why do you think that'll fade?
Because you can't return a $2 billion fund writing tiny checks into pre-seed companies. You can't return a $2 billion fund.
Talk to me about that. You can invest in Slack when it's a gaming company that pivots into Slack.
Listen, it's a thing. You got to stay in market, right? If you're a late stage growth fund and that market was dead last year, it's definitely better to stay in market for a variety of reasons. It's not silly. It is good to stay fresh. It is good to meet entrepreneurs. It is good to deploy capital. But if you've got to deploy $2 billion over 2 years and triple it, or come close to triple it, you've got to be in like 4 or 5 big winners a year, right? And significant ownership positions in all of them, right? The math is just awesome. You need double-digit ownerships of 4 to 5 massive $5 billion plus outcomes per year. And it's great if you can start in seed, right? But if it distracts you from putting 100 million into the winner, it's not worth the distraction. We were talking about distractions before we got on, and this stuff is distracting for these big funds, right?
I agree, but this is what worries me. The big fund partners are saying, I'm underwater with refinancings, with board positions, with company closures, with rifts. Principals and associates who haven't led rounds before, go and write $1 to $2 million checks, go and spray some seed cash. And that's leading to less and less price discipline at the seed because you've got this whole new entrant of less experience.
For insiders, Harry. For insiders. Even me as a founder back in the old EchoSign days, one of my favorite VCs that I love, Josh Stein, who runs Threshold today, was more junior back then. And he came, the first time we met, and I love him, he gave me a term sheet and he's like, well, listen, we can do it 2 ways, but if it's 2 million or less, I can just do it. When he was at DFJ. So it's not new, this idea of like bigger funds having a lower threshold for different professionals. It's not a new phenomenon. The funds are just bigger, right? But there's also more startups. I don't think it's bad, but my point is, those deals where the principal, or maybe Josh was a general partner back then, I don't know, but the deals where the principals of the VP can do it, they're pretty hard if you didn't come out of Stripe, come out of YC, or have traction. Okay? It's not as simple as it sounds. But finding that almost solo founder from Lisbon that knows no one, that only doesn't even have a desk in San Diego, like when I met TalkDesk, or these non-traditional other entrepreneurs, they're not going to just check the box. It's that 5-minute check the box has to have something else supporting it beyond, I think it's a great idea, or I love the idea. No one wants to throw their money away, and I love the idea, right?
So Jason, help me. What happens at seed then? We have this increase in supply from operators, a temporary increase in supply, but still an increase in supply, no matter how temporary, from multi-stage funds. What do we do at seed then as the traditionalist seed investor, and what happens?
Well, look, I think you have 2 choices. One is find outsiders. Outsiders most of the world is not privileged, Harry. Most of the world did not graduate from Stanford or Stripe or Y Combinator. And when you find outsiders, they're not dumb. These are the best entrepreneurs, but the prices are much more reasonable with outsiders, right? They're much more, they always have been, and they still are today. And they even were in 2021, outsiders. Insiders are priced to perfection, but if we take a pause, shouldn't they be? The venture markets have changed so much when I started as a founder, venture was so small, the firms would collude. I remember when I got my first offer from a VC, I went to meet another VC and they'd already called each other, agreed on the price and agreed to lower the price and split the round, okay? That doesn't happen so often today. Now, like if you have the hottest startup in the world, why shouldn't you be 700 pre in your seed if you want it? I mean, there's downsides to raising at 700 because the next round may be tough, but let's put aside that meta issue. Why shouldn't the perfect seed round be priced to perfection, right? And that may make seed investing impossible for seed funds, right? The seed round price to perfection only works for mega funds. It does not work for seed funds. And the seed investors are crying all over Twitter, but maybe that's not their job. Maybe their job is not to invest in the perfect, high profile, obvious, perfect seed fund. What did Jody Bonsall, after selling AppDynamics for $3.7 billion, raise his pre-money at Harness? I bet it was 100 pre even back then, right? And Menlo did it, but maybe I can't do it. It's okay. Go find Jody before his first one, not his second one, right?
I have so many things to say here. One, you say about kind of outsiders and how they're priced differently.
Yeah.
I agree with you. This sounds awful. I don't know if I'm going to regret saying this, but also many have said it before on the show and to me privately. Never done a deal from a inbound.
Right, and I disagree. And I've asked, I did this venture digital event back when there were digital events, Harry, and I had Keith on, I had David Sachs, I had Eileen Lee, and I had Satya Patel on. Okay, and I had them all. It was just a VC only event, and it was my lead-off question. And I said, because I've done multiple true cash out unicorns from inbounds. Right. And I asked them all, Keith, how do you do it? David, Satya, Eileen. They all have done some of their best investments from cold inbound. All of them. Now, they all like different things. It was really interesting. I think I may be misremembering them. I think Keith wanted a deck. He's like, just send me the deck. I'll flip through the deck. David wanted a really short email, like maybe the simplest way to atomize the whole thing. I like the world's longest email with everything in it and the best deck. Like, because I want to learn everything about you before I talk to you. And I can't remember what Eileen said she liked, but they all did it. And then some people don't do it. But I also think what gets confusing is it doesn't work late stage. No one in the world wants, no one at SoftBank or Tiger or even the better ones, the Iconics, or I can't imagine any of them respond to raw inbound emails. They may do something that's close, right? It's like, hey, Doug at Iconic, I know I saw you at SaaStr Annual. Let's catch up. That's not a raw inbound, is it? So when I ask growth investors, they think it's insane, but that's a pretty good lineup, wasn't it? And I can't remember which of his like Decacorn Satya said from Homebrew that they did from raw inbound, but it was one of them, right?
And I totally get you, and I think it's fascinating to hear. You said about kind of the price to perfection not making sense for seed in terms of the traditionalist funds. Sam Lessin said in a recent post that we'll go back to a stage where seed investing is high-risk capital going to high-risk ventures.
Yes.
Disease treatments, space treatments, you name it, but like really high risk. Do you agree?
Well, listen, he's smarter and probably more successful and experienced than I am, for sure. I don't agree at all. Again, I think it's possible he's reacting to the $700 million seed. I don't think seed investors can participate in hot startups anymore, right? I just don't think you can make money in seed investing in hot seed startups. I don't think you can. And I can give you a story on that in a minute. But I think he may be focused on, we're all kind of remembering the days when everyone could invest at Uber at 4 million pre or whatever it was, or remembering even a more recent deal when like deals used to take a month to happen in the old days, and you could collaborate more on them. And there were certain natural, when I started investing in SaaS and cloud, there were a few natural floors, like seed rounds didn't really get done north of real seed, like early stuff, but with revenue, didn't get done much more than 10 post or 10 pre. They just didn't happen that way. Not later, not once you're getting more revenue. But so you had time and you knew the price and you could socialize things, right? And those days are gone, this socialization or a month to get to know the founder and stuff like that. And but we can't lament the past. A lot of the best, the Peter Thiels and others, despite some of their toxicity, the point is that every month there's an amazing startup born, right? Every month and every week, there's a pretty darn good startup born. The hard part about seed is, if you want to make real money, you've got to get in earlier and earlier. That's the stressful part today. You got to get in earlier and earlier. You can't invest at a lot of these at $1 million in revenue anymore. It's not seed anymore, is it? But you can still be the first person in. You can still be the first person in. That's a hard job, to be the first person in.
What's your story? You mentioned a story on this.
Well, it's an adjacent story, but I think it's very telling. I was talking with a founder I invested in where I was the first investor in. And in today's market, they had an offer to invest at $450. Okay. And they're doing double digits in revenue. This isn't pre-seed. Okay. But but I'll tell you the point of the story. They had an offer to invest at $450. And he said to me, this is the first time as a founder I've paused. And I'm like, what do you mean? He's like, well, he sat down with me and said, I'll invest in you at $450, but let me tell you what it's going to take for me to make 5x net on this investment. With dilution, another round in an IPO. And the founder immediately walked from the proposal, right? I mean, it was the first time on that path from 6 to hundreds of millions in valuation. Here's my point, that he paused and thought what the implications of all of this are. That's just a whole new world where founders don't care anymore what the implications of these valuations are, right? But this was the real world moment where it became alive, and I applauded him for doing that because it may be a case where taking that optionality off the table wasn't a good idea.
Can I ask you, I spoke to one investor yesterday and they were like, I'm a bit jaded actually at Seed right now. I'm seeing every AI outbound sales tool, every AI marketing copy creator, and it's the 1,000th version of the same thing, really. And there's incumbents that are just going to do AI, adjacent products that they slip in as features. And I'm a bit jaded. I guess my question to you is, do you feel the same way in terms of slightly the jaded nature of the 1,000th product? And has anything made you snap out of it?
Well, I'll tell you a bigger issue I have with this, right? I get it, right? And but categories get reinvented, right? They get reinvented every 4 to 5 years. And when I started investing, I had a rule: the more crowded a category, the later I would invest. So, for example, when I invested in Pipedrive, it was CRM. There were so many folks that wanted to do Trello for CRM. Okay, and really the only reason Pipedrive won was because of the secret sauce of ingredients you needed in the early days. They got the mix right. Okay, they got the sliding, the Kanban right, and the ease of use. But there were 10 other Kanban CRMs out there. And if I had to guess at 5K MRR, I would have guessed wrong. But the second investment I did was Algolia. Now, at the time, Algolia had one competitor, Elastic. So I could kind of, at 8K or 10K MRR, I could make an educated decision. Okay, how does this compare in a market of N equals 2 direct competitors, right? They had indirect competitors, right? And what I would love to do in this AI space is wait. I don't think we need 88 sales outbound tools, especially when the leaders in sales is perhaps the most impacted category in SaaS today, right? A lot of the sales leaders are growing 0%. And so it's very hard to even understand what's happening with some start, because there's so much innovation in sales, right? But yet it's probably the most impacted category overall in leadership. So I'd love to wait to 1 million or 2 million in revenue. I'd love to wait to 1 to 2 and see someone break out a little bit and then lean in, right? But I can't lean in at 100 or 200. So that's the issue. It's not that I'm jaded, but I'm discouraged because there are categories I can no longer wait in that I used to wait. TalkDesk call center, I mean, it was disruptive what they did back in the day, but I wouldn't have been able to. It was still a slightly crowded category in the early days. I was able to wait until 1 million in revenue and have at least a hypothesis why it was going to break out, right?
Do you see the massive bundling in software buying today? A lot of people are mentioning how we're moving from a world of unbundled to bundled in a bit to save costs within large. Do you agree with that?
It's starting to be in the rearview mirror, Harry. We are bouncing off the bottom. We are bouncing off these lows that we went through this period the last 18 months where not failing unicorns, big successful companies retrenched their IT and spend budgets, right? All across the board. You saw it across your portfolio. And they did it, and they did two things. One, they spent an enormous amount of energy cutting back spend, cutting back workflows, cutting back cloud spend. We saw this with AWS, Azure, Google. Like, how can I'm not going to cut those applications, but how can I optimize my workflow? Mongo saw it. Everyone saw workflow optimization, Datadog, right? And then they went through a second thing, which I call the app layoffs. Okay. And what they did is, and you have to have been through a real human layoff in a big company to get how this works. But here's how layoffs work in big companies for both people and human beings. Okay. And these are companies that are successful, right? These are big companies. They're all they're all so growing. They get all the VPs in the room and you go around the table and you're like, you got to cut one person or one app. Okay. And the first one's pretty easy because there's one person on your team that doesn't even show up to work anymore. So you're like, Lemkin, let's fire, like throw him in the table. And when you go to the VP layoff meeting in a big company, like if it's a small layoff, like less than 5%, people are actually happy at the layoff meeting because they haven't been able to get rid of Lemkin or Harry for 5 years. They're so excited. I can finally get this toxic person that doesn't work off my team, and everyone's drinking and having, not alcohol, but coffee and having fun, right? And then the second meeting happens, it gets harder, right? Then you start to cut closer. And the third meeting is not fun. And we only got through 2 of these meetings in apps. So everyone got around the room and they said, look, we got to cut 10% of our apps. Like we're going to cut 10 or 20% of our spend. And these guys are going to work on this. The procurement finance guys they're going to manage it. And we're going to just cut names. And so everyone bought some app in 2021 to send free mugs to their sales team or to automate some obscure process because it was just go, 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 go. And they're looking and like, we're barely using this. So they cut that one, right? And then they did another level, and this hurt some real leaders. So the first one, they just cut the one they were barely using that seemed like helpful, right? And then the second one, and this was tough for some of the leaders, they're like, well, I really want some wonderful products like a Gong or an Outreach, Epic products or others, but I've got that feature in another product, right? This isn't Suites. This is not the same thing. And they're like, I'm going to cut back my spend on Gong because I have some of that in Salesloft or Outreach, or I'm going to cut back some of this piece. It's not like those ones, those are great companies that are doing hundreds of millions. They just saw this impact from, I'll settle for a crappier solution because it's already in something I'm paying for. Okay, so these two things happened, and we're done, Harry. There isn't going to be a third or fourth meeting. If you look at Mongo's latest quarter, if you look at Atlassian's that just came off, we're not ripping back at 2021, but they have all bounced off the bottom. Mongo is up, Atlassian is up. Not everyone, even ZoomInfo, which is like the most pure play sales and marketing tool out there that's like us, it still had a rough last quarter, but not as rough as the prior quarter. It bounced off the bottom. They're all bouncing off the bottom because your CFO and CIO can't spend their entire lives optimizing workflows. And what Amazon said yesterday was very interesting. Amazon said the cutbacks have been more than counterbalanced by the amount of AI workflows people are putting on. Okay. And we can say that's all AI, but what it really is listen, AI is so disruptive, we got to spend again. And maybe AI is the vanguard here that's pulling spend out of the enterprise and companies, but we've bounced off the lows. And if you're a Debbie Downer, you're missing what's happening in the enterprise. You're missing what's happening with buyers. We have bounced off the bottom. How high we're going to bounce? I'm not saying we're bouncing to 2021. It's going to take 20 years to experience that moment again. It will happen again. It's every 20 years, right? But 2024 will be rich with IPOs. And it will be a good year with solid multiples.
We're going to move into that over time. I do want to kind of do it stage because it's easier to follow then. Okay. I do want to move into the Series A. We discussed their seed being untouched. We discussed pricing being relatively untouched, capital supplies. Series A, how do you think about the Series A and B market today?
Terrible. I think it's terrible. And actually, I would ask you, in some ways, you may have a better perspective. Look, everything's better than a year ago. Let's be clear, no matter what Twitter says. Like, it was interesting, Iconic Growth published their data when they came to SaaS Europe in June. Iconic Growth, I think, had done 4 growth deals in 2023, 0 in 2022, 0. So from 0 to 4, I don't know what their traditional pace was, but 0 to 4 is pretty different, right? The deals were lower valuations, right? They were lower perceived risk, which is important, right? And so everything's tougher. I just think, A and B's today, the reason there's a huge slowdown at A and B is not because the money isn't there. Everyone that's good has a fund, Harry. I'm sure you agree with me. Everyone that has a track record has a fund today. And in fact, they often have an undeployed fund, an underdeployed fund. Everyone is good, right? LPs are culling names and folks without a track record are having trouble raising another fund. But if you're pretty good, you got a fund to invest today. Everyone's in market. In some sense, everyone that's good is in market, but A and Bs want a return to rationality, right? And founders aren't there yet, and they may never get there. Every founder that raises a seed round still thinks in 12 months they're going to raise a hot A. Not every founder, okay, but every founder. So there's a large disconnect between what A's want to do and what founders think an A is. And I don't think that that's been diminished much by the tumult of last year because these are newer founders and newer companies, right? They haven't been through the tough times.
So what happens if they never get that, but A's and B's want different things than they used to or are willing to accept less than they used to, or more than they used to? What happens?
I don't think it's that big of a deal. Some of them will just fail, and that's fine. Seed companies it's okay if some fail. It is seed investing, right? They don't all grow up into a mighty oak. And some will get religion and struggle for 6 to 9 months and gain humility and raise a normal round. It's a tough venture strategy. It's a tough one, but the one of waiting and investing in the ones that miss the window, but then accelerate a little after the window. That patient model, you can criticize it, but if you're very disciplined, it works. The ones that they couldn't raise the A 14 months after the seed, it took 24 months, but then hit the number, being disciplined, picking over YC a year afterwards rather than a month before. The problem with that strategy, it doesn't produce enough decacorns, but it sure works. It sure works if you have the discipline to do it. So some of them will just have to wait. They'll just have to learn. They'll have to have a life experience. But the ones with high burn, they're all going to fail.
What happens to the ones who've got low burn and 10 years of runway? Transparently, I have quite a few companies which got preemptive A's. They literally have 10 years of runway. They do not have product market fit. What happens there?
I think this whole ZERP thing is abused, what happened with ZERP. But this is a ZERP phenomenon, if nothing else. We'll never again see a massive wave of startups with 10 years of runway and no traction. This is going to take another 20 years to happen, okay? There should be a massive wave of startups with 12 months of runway and no traction, but not a decade of that was a ZERP phenomenon. And look, I don't think we know, right? My advice to all of them is they should offer to give the money back, 100%. Offer. And I said offer. I didn't say give it. I said offer. 100% should offer to give the money back. It's a great process. It's a great process. When, Slack, before it was Slack, was a gaming company, right? And Stuart Butterfield, when it didn't make it, his second gaming company, he offered to give all the money back. He offered to give what was left. He'd spend about half. There's a whole Andreessen post on their blog. It's great. And Andreessen and the investors actually thought about it. They thought about it for a beat, right? And they said, no, you're one of the best entrepreneurs. You just go do what you want to do. If it's this Slack thing, the 10 millionth messaging tool, and that's what you and Cal are passionate about, go do it. But he offered. But Harry, he offered. And if you do that to your investors, it is the most profound bonding moment. And it is the ethical thing to do. Founders today don't respect venture capital anymore. They don't respect venture capital. And it's one of my least favorite parts of the industry is that founders do not respect venture capital anymore. And I over-respected it in my day. Venture capital was so hard to get when I started in this industry. We over-respected, like we thought it was dad and grandpa, and we genuflect, and we brought them coffee, and we met them at Pebble Beach, and like venture capitals were gods. Now it's swung so far the other way that founders have no respect for money, most of them.
Why do they not?
I think it's what they've been taught, that it doesn't matter. It was like this great founder we talked about before who didn't think about what money meant until he wanted to raise it 450 and finally having to exit at 3 or 4 billion. But they all think it's a game. My friends raised at 80, Harry. There was a deal I almost did. Okay. I love this founder. He was, didn't even finish high school. I've done young founders before, but this would have been my youngest. Okay. This would have been my first that, couldn't, what can you do when you're 18 that you can't do? Well, he would have been the first. What's that?
I couldn't drink. I remember raising from an endowment fund.
Yeah, well, you're in Europe. I forget what it is in the States. Although he was European, and I wanted to do it, and he's like, well, and obviously if he's 17, he has limited life experience raising venture capital. He's like, well, I'll let you in at 20 today. I'm like, well, listen, I'm not arguing with you. I'd never argue over price, but for where you're at today, I can't do it for a variety of reasons. He's like, yeah, but in 6 months, I'm raising at 80. And I'm not even criticizing him. You got to have some chutzpah sometimes to be a founder. But my point is, it's just this disconnect for what anything means, what an exit means, how hard it is. And no one cares I don't find very many of the current generation founders actually care about returns for their investors. They actually care about. Stuart cared. Stuart's like, he wasn't rich. They sold Flickr for $40 million to Yahoo, but they had a bunch of founders and investors. How much did he make, even at Yahoo? He made millions, but not tens of millions. He wasn't rich. And when there was a couple $1 million in the bank, he respected a couple $1 million that was left from the seed round. He offered, because and I over-respected money myself, but today it's like whatever. And that one founder, the only one I did that had 10 years of runway, I asked him to give the money back. And you know what his response was to me? Why do you care? Now unpack that for a minute. Why do you care?
He's suggesting ultimate detachment from you and
all of it. Yeah. He didn't care whether I made money, but he didn't understand why I would care. Venture is just a sport. It's just a game. You're just throwing dice on the roulette, on the whatever the crap. I don't gamble. You're throwing those dice he couldn't understand why I would care. I told him you should got to offer. You got to offer, right? You've abandoned your current business model. You have 10 years of runway. You got to make you don't have to take it, but you got to make the offer. And his answer was, why do you care?
So I'm going to people get upset with me for this. That's why I prefer 1, older founders and 2, serial entrepreneurs. I find with both, you do not get both of those situations. You don't get the blasé, I'll raise it 100 in 6 months time. And you don't get the flippant, why do you care? Kind of moody, which isn't cool. I
like the opposite of that 2x2, but I hear your point.
Well, hit me. Why do you like the opposite of the 2x2? Because I think, and again, this is just, I feel that there are so many things that are stupid mistakes that first-time founders make that take serious time and detract from precious runway that can be avoided on serial entrepreneurs.
They can.
And I would rather pay 2x and avoid those terrible mistakes than.
But you're right. And you're right. Well, first of all, you often will pay 2x, right? And it's not that it's not worth it, right? But you have to, again, it goes back to our first point of your strategy. Does your fund strategy and size and risk profile permit you to pay 2x to de-risk that investment, right? From my perspective, as someone who has built a SaaS company that even today is doing 250 million, that has been a founder, that has been a decent investor in first-time founders, I feel like I can help mitigate that risk by working with them. I can help them avoid, not all they're going to make 70% of the mistakes, but I genuinely feel by bringing them their first VP of sales, by bringing them their COO, by bringing them their first marketer, by helping them hire all their reps, I know these mistakes and they're still going to make a bunch of them, but I feel like a superpower I can make is mitigate enough of them that instead of a 2x entrepreneur, they become a 1.25x on, whatever. I give them an extra, I think I give them an extra 0.25x.
Dude, I think you give them a lot more than that, but I do think that you never want to invest in founders that need you, and I think those founders need you. I much prefer...
No, you know what the difference is? They want you.
No, they do need you, because, dude, they need you to close that VP sales. They need you to close that CRO, whoever that is.
Here's the fallacy in that thinking, if you want my learning, right? I hear you, and that's the classic... Vinod Khosla, who's wildly successful, like the classic is my best founders don't need me, right? That's what they've said. And listen, he's a better investor than but I'm 10x lifetime, so I'm not bad, okay? I think what's missed there is that if you're a true outsider, if you just showed up in the Bay Area from Lisbon or even London, okay, or Estonia or Paris and know nobody, like you didn't even get to go through YC, you know nobody. Yes, you're tenacious as hell. Yes, you grabbed your whole family and moved them out here. And yes, you are committed, but but if I can be an insider and give you some of those connections you don't have when you get here, that's not needing me. That's me accelerating a process that would take you time to develop. You can't show up in, the Bay Area, literally or sort of metaphysically speaking, and have 100 connections on day one, can you? How can you know them? Yes, you can hustle your way and go to all the AI events in Hayes Valley and schmooze on Twitter, but like you just cannot build the 20 years of relationships I have, or even the decade you have. You can't build those in 1 week showing up, right? And if so, totally agree for Series C. For seed, there's a couple. I love several founders. Like the Showpad founders said, I was the first person they met when they came here from Belgium, from the US, right? And so if you can help someone like that, they don't need you, but you accelerate it. It's outsiders versus insiders. If you have to help insiders, it's embarrassing. Those third-time founders, if I have to help Jody Bonsall find a VP of sales, I mean, we owe it to him to find him one, but he'll find his own, won't he?
I think it's tough because I get you entirely, but I think it's tough because it's not as black as white as insiders and outsiders. There's quite a few people who were a PM at New Relic, at Algolia. They're not inherent insiders, actually. They're not sitting at the dinner table on a Friday with Collisons and with Sam Altman, but they're also not from Belgium like the Showpad guys, totally out of it. And I find those are often the ones where the real painful mistakes are made.
Yeah, for sure. Look, I'm not disagreeing that paying 2x for the seasoned founders is a good bet. I just want to invest the extra time on the Gorgeouses and the RevenueCats and TalkDesk and Algolias. I'm willing to invest those cycles to see beyond those and take that risk. And I think the risk you take is more rational. It lets you deploy more capital. And if you put it on a spreadsheet, it's probably the better risk to take. Many of the best investors do that. For me, what I don't like is the only way I can invest on the 2x founder in my fund structure is pre-revenue. Okay, here's my learning. It doesn't work for me unless, and I've done it, and I recently did this analysis. It's about 50-50 for me versus 90% of an ordinary investment.
Talk to me about that analysis. Sorry.
The average investment I make makes money 90% of the time, okay? Over 10 years, okay? And that's not all good. It means I'm not taking enough risk, blah, 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 blah. But it's just the spreadsheet. The only pre-revenue ones I've done are these repeat founders, these 2X, that had big exits that I know personally. So I know them personally. There's no ethics issues. I don't have to do any diligence. Only half of them are going to make money. Now, if that's your approach, half is still pretty good, right? But I have to pay more and they're all pre-revenue. So I have to take like a year to 2 years more risk. There's a couple I regret, right? Don't get me wrong. I'm not sure. I'm just not sure looking at the spreadsheet, like looking at a company, I'm not sure.
In the ones you regret, what do you regret in terms, like, what did you not see that you see now?
What did I not see? I think it's more the opposite. I see less now.
What do you mean by that?
It's just everything's so much bigger. There's so many more startups. And frankly, for me, like when I started investing, like SaaS was seen as a dumb area to invest. People made fun of it. People were like, no, you should be doing either fintech or consumer. It's stupid. So yeah, I saw almost everything, but there were only 20 or 30 SaaS investors. And there was only one that had a blog or two. Me and Tamaz were about it, and Christoph. There were three of us that had any social presence, and there were only 20 or 30 of us. So you didn't get to see. You still can't see every seed deal, but it was much easier to see them all in a smaller universe. I think my biggest mistake, and you're not making it, Harry. I think the biggest mistake I've made, and this is just me, because everyone's different. This is the complicated thing about ventures. Everyone has different strengths and sweetnesses. I think where the world evolved in 2023, I should have built a big team under me, but I didn't want to be that guy. I didn't want to manage 10 or 20, whether they're full-time GPs or folks running extra related funds. My LPs pushed me to do it, right? People wanted me to do it. But I've already been an entrepreneur twice, and I got to enjoy what I'm doing. And I did not want to be whoever, this massive fund manager. It just wasn't me as a human being. I consider myself a founder first and an investor second, and I just couldn't do it. I think people get it wrong. Why do folks raise bigger and bigger funds and all of this? They think it's for the fees. It's not for the fees. It's because that's what it takes to sustain a team. This is what I learned from Sunil at Amplify, right? Because he went from an amazing solo GP and did Datadog, and then he built them into it. And I asked him one time why he did it. He's like, well, I have to do it for the team. Like they need their 60 million per fund and then their 100 million. Like I can't have 4 GPs and the 4 GPs need associates and I need like 10 people. And so I got to raise this fund size. And he was like, if in a perfect world, I might do it on my own, right? Or just him and his partner. But again, the strategy dictates the fund size and the strat, right? And so
100%. If you do it on a capital per partner basis and then figure out your deployment cycle, and if you do a 3-year deployment cycle and you're doing $10 million Series A's and you want to do 3 a year across 4 partners, actually you can work your way very easily to the $500 million.
Yeah, you need 500 million with 60% reserves to make that work. Otherwise, you're taking too much risk. You need 500 million. Right?
Exactly. And so
that means you need 3 billion of exits, right? Gross. So that means you need 30 billion of market cap to make that fund work. If you have 10% real ownership, 30 billion of market cap. So let's say that fund has a pager in it. And let's pick another one, another great one. Let's say it has a sprinkler in it. How far am I to that 30 billion? And I'm raising 500 every 2 years. I got to get so many of those 30. I got to do 30 billion of exits every 2 years.
Yeah, buy real estate, which is the other option. So, but before we move to growth, what happens with Series A, Jason? Does it stay in the doldrums for long? Does it rebound quickly? How do you advise founders who are asking you this?
Well, I have 2 different perspectives, one from venture, one from seed. I said this a few months ago, and then I said, hey, Series A is the best place to invest today in cloud and SaaS, right? And David Sachs's response was, shh, don't tell anybody, right? Because when you have a dislocation at a stage, that's where you make money in venture, right? There's no dislocation in seed from the Carvana conversation. Anyone that thinks seed isn't happening, they're out of their minds. We still have hyperlocation in seed. We don't have dislocation. There is an inexhaustible amount of seed capital, at least for hot companies. Inexhaustible. Every YC company in every batch, they may not all get funded, but there is enough capital to fully fund all at 20 post. That only takes 200 million, 2 million. That takes 400 million to fully fund a YC batch. There is 4 billion of capital that would like to invest in that batch, right? Whether it happens or not is a different question. But I do think there's discipline in the market for the moment outside of AI. Outside of AI, there's discipline. And so founders either have to respect that discipline or realize they may not be able to raise, right? And so everyone in Series A is being disciplined, and maybe they're being too disciplined. That we'll have to find out, because cloud is up 35% this year. If you measure it from the peak, it's down. But, I deployed all my cash at the beginning of the year. Like, I feel smart in the public markets. If I deployed it all at the peak, I would feel dumb. But I happen to have a lot of cash at the beginning of the year. I put it all in. And so it all depends on your perspective. But A is the best time. But let me summarize it this way, Harry. I know this will sound obvious to you, but founders still don't get it. Every round's supposed to be harder. But in 2021, every round got easier. Think about it. They literally got easier in 2021, didn't they? It's not just that people raised at 400 and then 800 the next week. It's not even that the valuations went up. They actually got easier. The hysteria raising at 400 made it easier to raise at 800 because I didn't get into the round, right? And every round the A should be somewhere between, maybe it's step function. Maybe an A should be 10 times harder than a seed and a B should be 10 times harder than an A and a C. That's the way it certainly was when I started. Each round was probably an order of magnitude harder to raise than the last. It's supposed to be a win-win. It's supposed to be a win-win, right?
Speaking it should get harder. You tweeted before, I'm leaving out the company because there's a friendship there for me.
Yeah.
As usual in VC due diligence, no one actually cared. What did you mean by that, Jason?
Well, I was having a little fun, but, I remember my entire life as an entrepreneur or investors, I try to avoid any time a VC wants to do diligence with me. I try to studiously avoid it. And I remember my very first company as a founder, actually, we made implantable batteries from nanomaterials, very hard tech, okay? And it was what we did was impossible. Only a handful of people could do it in the world. And this fancy VC fund asked my co-founder, my CTO, and me, and she knew more than me, we're looking at the startup in the space. What do you think? And my co-founder, who's very cautious, very, very cautious engineer, right? Very calm. She gets on the call and she says, let me tell you, I've worked in this space for a decade. And I actually did some work here. It's impossible. What they're doing is impossible. It's a fraud. It can't work. And then she explained not in the emotion I am, very calmly, here's why. And the data that you're looking at is accurate, but you're reading the wrong things from the data, right? And they said, very thank you, and wrote a $20 million check that they quickly lost. I'd never really done that before, done diligence for a VC fund, and I found it very frustrating, right? And not profoundly frustrating. And then I learned subsequently every VC diligence call is like that, right? And there are certain spaces where I know something about, right? There's certain spaces I know something about. And people ask me for event software, right? Because we do events. Like they ask us for C-Vent competitors, and they ask me for certain types of social media, like they try to ask you, right? And there's certain categories that I've invested in. They ask me about contact center and call center, and they always ask me to help them with diligence, right? Because I'm a subject matter expert. Usually I don't say anything, but once in a while, I know something's just a terrible idea, and I tell them. And they always do the deal anyway. And why? It's because the diligence is always confirmatory. VCs decide they want to do the deal, and they don't want to hear reasons to not do it. They don't want to hear it. So it's a niche topic, but I've given up almost entirely on my response to ACT now usually is it's a good space. It's such a waste of time, right? VC, the real point is, how did we get into all this FTX trouble? And every VC has a fraud in their portfolio. Every single VC has a fraud in their portfolio. And there's a couple reasons it happened. It was the pace, right? It was the times, it was the markups. But it's also the fact that VCs only do confirmatory due diligence. The truth is they only do confirmatory due diligence. They make a decision based on a certain set of assumptions, and then they go off and do diligence. And the more competitive the deal it is, the more compressed the timelines are, the less they take objections in that diligence properly, right? That's how VCs can do diligence after a term sheet, because it's going to close if it's a good fund.
Do you think we will see a wave more of fraudulent companies come out?
No, it won't come out because the VCs aren't talking about it. They're just marking them to zero. Fraud's everywhere. And there's different layers of fraud. For example, just lies. Lies are not always crimes, right? This is like the great Trump debate. What did he say? That, like, I think what the indictment said, it was okay for him to lie about the results not being right, but something else he did was illegal. Like, founders can lie about certain things and it's not fraud. I actually think it's all fraud myself. But everyone's got a founder that claimed they had ARR that really mashed months together, that their financials were not accurate, that misrepresented a plan that was that literally or compressed a bunch of revenue wrongfully right before fundraising that wasn't really quite there after fundraising, or misrepresented their gross margins. Right? It's just all over the place, and everyone's got one in their portfolio. Any VC that says they don't either isn't close to their portfolio, or is ignoring it. Everyone's got fraud.
The thing that worries me, though, Jason, is honestly, I think, fuck you. You lied.
Yeah.
That is like egregious.
The fraudsters don't care, Harry. That's the thing.
No, but I speak to many VCs who receive the same from founders, and they go, but I don't want to do anything. It could be bad for my founder NPS. And I'm like, are you fucking serious? Like,
Might be.
who gives a shit? I'm sorry. Someone
I don't think
lied to
I don't think you want a lot of negatives on Bookface, Harry.
Honestly, if someone lied to me and misrepresented numbers, I don't care if they say bad shit about me, because the people that listen to them will likely be shit.
I think you're right, but having said that, listen, the amount of fraud I've had is relatively small, but what I have had to deal with, I've had to be the one to give the hard talk to the founders and been the only, we've talked about this before, been the only one to do it again and again and again. My NPS has been damaged from it. I'm confident of it. My NPS has been damaged. That I've had multiple times when the company was going to drive the car off the cliff. I had to have the talk, and it saved the company, right? And anyone but the great founders don't forgive me. Now I do have one company I did a long time ago with this, and they're going to have a big $300 million plus exit to announce soon, having raised very little. The founders will make a lot of money. They took that advice well others, but I've had serious NPS hits from this. I think the answer, I think this is a complicated question, right? And I think it makes logical sense as an investor if you can afford to walk away from a toxic situation. Like there used to be board partners, and there still are, and they're there for a reason.
Listen, I totally get you, and that is a fair point in terms of opportunity cost of time. It's one where I feel
it also avoids it also avoids the tension. It's not just the opportunity cost; it's the tension.
Talk to me about that. What do you mean?
The NPS issue, all those issues. If you can walk away from an investment and leave the founders alone, it is not perfect, but it's certainly better than every 60 days having tension. That tension's good for the best founders, but for the less than the best founders, that tension, they just take it personally and they react to it, and it's not good for anybody, is it?
No, I agree with that. We mentioned diligence. I do want to touch on growth. We mentioned A and B being the best place, but also a bit of a dead zone, bluntly.
Yes.
What does that mean?
From a founder perspective, from the A and B, everyone has money at A and B. It's just slower than it was, right? But keep going. Yeah.
From a growth perspective, as we mature down the pipe, is growth dead too? And how do you analyze the growth stage?
I'm seeing something different in my portfolio. And look, we have very different portfolios, right? What I'm seeing today where we're talking now, is a very active growth, but with very specific boundaries. Okay. For example, I'll be listen, let's put aside the AI outliers. Okay. It's a conversation we won't have today. We'll run out of time. For traditional cloud companies, SaaS companies, at growth, I would say, generally speaking, there's a 15x ARR ceiling, pretty universal. Now there are exceptions out there, but you got to work them. There are all the growth investors. If you have a good company, it does have to be more efficient today. Okay. But if you're at the growth stage, 30, 40, 50, 60 million in ARR, okay, and you're not burning epic amounts of cash, you will have a series of term sheets laid out in front of you at 15x ARR if you're a good company. If you're at 30, 450. If you're at 50, whatever, 650, right? 10x, 15x is sort of the reach. And maybe that will flex later this year if multiples continue to re-expand. The only problem is, and when I talk to growth investors, there just aren't enough candidates like that. They've raised at too high prices. That's the main reason. And the secondary reason is because they're efficient, sometimes they just won't take the deal today. 15x is not a bad deal. The public averages 6x. You can't intellectually say it's a bad deal. But if, Harry, you and I are running a SaaS company, we're at 40 million ARR, we're kind of break even. And nice guy growth fund wants to buy 20%, but then we have to do more and we have to report to them. And you and I, we don't need the secondary, and we're not sure what to do with the money. It's not that we would say no, we might just wait. Like, hey, Harry, let's do it at 60. Let's wait till next year it's feeling pretty good, Harry. Like, why don't we do it at 60 or 70? Like, this seems like a stressful time to do it at 40 or 30. And so they're either waiting because there's not urgency, or they're sitting at a valuation where the growth round's not possible. But they're literally putting these 15x term sheets like on the driveway like a used car. They're all out there, and they're hoping that they'll take. And in the interim, what they're all doing is secondaries in these companies. Like the companies I have that are north of 30 million are overwhelmed with growth investors trying to do secondaries.
Talk to me about that. What's happening there?
If I can't get 15x deal from the company, I sure can get it. I'm going to try to get it from the seed guys. Overwhelmed. The companies I have that are efficient, north of 30, they're overwhelmed with folks, often not to me, although sometimes to me, but from anyone else trying to clean up the cap table at the valuation they want. They can buy out everyone at 10x. That's early, right? If it's at 40 million revenue and I'm comfortable doing 500, but a bunch of guys invested at 10, like some of them will take the deal. And so that's what I'm seeing happen with growth guys behind the scene, is doing as many cleanup deals as they can, just aggressively doing ones that are in the zone, but the founders are like, maybe next year, maybe later. So like, maybe I can buy 4 or 5% today.
Do you think we'll see a wave of seed managers needing liquidity and DPI selling in those opportunities because of their need for liquidity to then go and raise their next fund? Or do you think actually...
I've seen both happen. I've seen folks that have micro funds sell, right? For sure. And sometimes that deal could return their whole fund, right? Or more, right? Sometimes. But I think Twitter gets another thing wrong. I recently had a conversation with one of my LPs last week about a secondary offer, that was 10 figures, a 10-figure secondary offer, okay? And we both agreed no was the answer, because we're in the business to make money. We don't want to take a discount, right? So I think what's confusing is like, is there pressure to do DPI versus TVPI and all this? Sort of. But the best LPs want these 6x, 8x, 10x funds. They really do. And they're more appreciative of how rare they are than we all thought it was. And the best LPs they know the liquidity will come. The best LPs, they've been doing this a long time, okay? And what I've learned is the best LPs want the highest possible return. And I asked them all, do you want cash? And all my LPs, my 3 largest LPs, said no, they don't want cash. Now, I know you'll hear other stories, but this is what I've heard.
No, I mean this lovingly, but I think it's very dependent on LP type. You have certain LP types, foundations, endowments that have annual payments for scholarships for...
And that's what I'm talking about.
And they need the liquidity.
Yeah,
today.
but I'm not Andreessen or Sequoia. I can't give them 10 billion of liquidity, Harry.
No, but they will take anything in liquidity right now. Okay,
listen, you have a bigger lens than I do. But what I can tell you, I have a smaller group of but pretty good LPs. I'm just telling you what I've asked them all this literally the last couple of weeks. Everyone said we want more. We want a bigger return, right? In fact, one of my LPs told me this last week, actually, we think you should reopen your last fund.
Why? What was the
because they think it could be a high enough return that they want to stuff as much as they can into that fund. They don't want the cash out now. They want the highest possible return from that fund. They said, this was a new one to me, reopen the prior fund. I'm like, I didn't think you could reopen a prior fund if you're investing out of a new fund. They said, we do this. It's not that uncommon as long as you get your LPAC and everyone to consent. If you can recycle or find other ways to put more money into a closed fund, put it in. Isn't that the opposite of DPI today?
It is indeed. What did you say?
I said, hadn't thought about it. and their point is, don't confuse gross and net multiples. Their point is, this is a great strategy. They said all of our best managers deploy well in excess of 100% of the fund as quickly as possible. And it's fine to do it later. It's fine to do it late in the fund's life cycle. Things pop later. It's fine to do it. Getting that extra 3x on that extra money into the fund, on that extra money can make the difference in those net returns. That was an aha moment to me, and I guess the thing about Twitter is different LPs are playing different games, right? And you've got to know what game they're playing. Doing a seed investment at 5 and exiting at 500 million sounds great, but if you own 10% and you have a $50 million fund, it's still only 1x. 1x doesn't pay the rent for anybody. So it sounds great. Wow, like if that could probably be a 50x return, right? 100x, like from 5 to 500, but let's assume 50x sounds great. You can brag on Twitter. You can put it in your slide for raising your next fund. You can tell all your friends. You can mock the folks that haven't had an exit. But if you're in it for carry, it's only a step, isn't it?
No, it absolutely
It's only
is.
a step.
I actually had lunch with one of the kind of biggest fundraisers, / GPs in the world who raises billions a year, 60-year-old. And he said, it has never been so hard to fundraise since the dot-com boom. That was the last time it was this hard.
For VC funds?
for VC funds. Would you agree with him? And do you think LP markets are shut for funds largely?
I think the problem is that we're still using 2020, 21 into 2022 as the reference. Yes, it's brutal compared to those 3 years, right? When I start, it's easier than when I started in venture. I'll sure tell you that. It was like impossible to raise a fund when I started 10 years ago, or when I raised my own first fund in 2016. Like, it's still so much easier than it used to be. Let me give you just 3 stories. My 3 largest LPs, okay, who again I all met with, and they all said don't take the secondary, the $1 billion plus secondary. They all said don't take it. One, which is a wildly successful university endowment for their category number 1. Okay, they're dropping 2 managers this year, good managers, no new managers, dropping 2 good ones, good, better than me, good ones. Second one, not going to do that type of venture going forward. They're going to do other stuff in PE and venture and other things, but not going to do these traditional seed Series A funds. Third one's done 3 new managers this year. 3 new managers this year and did 0 last year. Just like Iconic did the 5 versus 0, this other top tier massive LP already did 3 seed investors this year and did none last year.
Okay, so just break this down for me. Why is the first dropping those managers who are actually very good?
Wants to just concentrate in smaller number of winners to react because of the cash distributions, because of DPI. And this person, and this first one of the peer set of endowments was number 1 in his peer group. The only one that was positive last year for his group. This is one reason. The only one that was positive last year of his peer group. Everyone else had negative versus an average 90% IRR the year before. So 90% in the prior year, negative last year. So how do you react to going from 90 for him to still positive and for the rest negative? The instinctive reaction is to shrink, right? To shrink managers, right? And this is one of the best, right? So he's trying to figure out who's past their peak, who's past their prime. That's what you do, right? They were great back then, but Harry and Jason left. And I don't know if Bill and Bob are quite as good as Harry and Jason. And it was that kind of, it's this kind of industry stuff. One is just changing their strategy and the other is adding 3 managers versus 0 last year. So I think it's not that simple. But I do think it's harder and harder to raise the mega funds. Like, you can't argue the math, right? It's just hard to raise the mega fund. Emerging managers are delusional about how hard it is to raise a fund one with no track record. Like, what you could do in 2021 is unprecedented in the history of the industry, where someone with some Twitter followers and never having a record could raise a $50 million fund. It will never happen again. That's a ZERP thing. That will never happen again.
Do you know what I think actually we'll see happen is this interesting opposite of a shit sandwich, which is I think you'll see massive churn at the 2 billion plus level in your large mega funds. The LPs realize that bluntly, you need to return so much. What it takes to make those economics work is impossible or near impossible. Yes. And then actually this desire to consolidate managers and move away from the really early, less experienced emerging managers under 100 million who don't have DPI. And I think the ones that actually win are the ones in the middle at the 250 to 750, where they do have DPI, they do have track, but they're small enough fund sizes where you can still see real upside.
You know what I think, and again, I can only share what I've learned. I'm not as much of an expert here as you, but the other thing that some of these top LPs said to me is they challenged that a little bit. We had that conversation, and what they said is, yes, for traditional LPs managing a certain amount of capital, that makes sense. Okay, that's we're going to revert more to a classic type of investing, right? Where large funds are tough to make work, and it's way too much energy to work with emerging managers. It's way too much energy for not enough absolute return, right? We're back in the world, but the massive pools of capital, right? The massive government level pools of capital, even the big funds are optimized to produce a return for sovereign wealth funds. Sovereign wealth funds still have single digit returns. If you look at them, it is so hard to deploy that capital. And if an Andreessen or Sequoia and Bessemer and Lightspeed you think you have to have alpha to NASDAQ, but it's not that simple, right? If you can have alpha to their endowment and absorb $500 million a year, that's better than a lot of the things. It's just these massive. And so that's why they're all going to Abu Dhabi or Dubai, and they're all chasing these funds. And it's not as silly as it sounds, because the amount of capital they have to deploy is it's so large you can't even imagine. Even GIC in Singapore, it's so much money, right?
I agree. I heard a number that's actually 3 trillion in the next 6 years.
Yes.
Across
so that's why Twitter's a little bit wrong. Those guys you can't make money. Yeah, you can do okay in T-bills today. And, in all fairness, but even that, you can only buy so many T-bills as a sovereign wealth company. You can't become part of the United States. And so that's what these multi-billion-dollar funds are optimized around sovereign wealth type. They're not all sovereign wealth, but they're optimized around this. They're all products, right? Everything in VC that's been around a while is a product, right? Those products, I suspect, if they can return 10% a year reliably for real and absorb massive amounts of capital, they will be able to continually raise multi-billion-dollar funds, right?
100%. And to your point on like different people playing different games, a lot of people say with the large funds, like, oh, they've got a lot of churn in their LP base. In majority of cases, they don't actually care because it's a deliberate graduation from one LP class to another. From your endowment style writing 20 to 50 million to your sovereign wealth writing 250 to 500 and your pension funds in that realm. And so it's like changing the game that they play and changing the LP profile that sits with that game.
I think you just got to be careful on Twitter. A lot of people are grouching about the old times, but the times change, right?
No,
but the pools of capital, the amount of capital, I guess the last point is just the amount of capital, even with some valuation compression that we've seen in multiples, the amount of capital that startups can absorb pre-IPO still is large, right? The amount of money that's going to go into venture is equal to the amount of money startups can absorb pre-IPO, right? And even if it's gotten harder, if companies can IPO at a $5 billion, $6 billion valuation and a few higher, they're going to absorb half of that in capital, 20% of that in capital. They're all going to absorb it. One way or another, it's going to get absorbed, right? It's going to flow there.
Jason, what happens to Tiger and SoftBank?
I'm not close enough to know. I kind of admire the Tiger strategy, which was massive momentum investing. Momentum investing doesn't work once the momentum starts, right? But it sure worked when it did, right? SoftBank, I don't know. I just think when those things are going to die, and then when multiples get insane again, they'll all reappear. They're just high multiple vehicles, right?
What have you changed your mind on in the last 12 months?
Okay, I'll give you a tough answer. It's about tech more than investing per se, right? I've changed my mind on the distributed world and distributed knowledge workers and everything, and I've just gotten a little jaded, and I just don't think most of the current generation of folks will ever work hard again. I'm using much deeper scrutiny on executives and hires. Everyone has a side hustle. Everyone's working 20 hours a week. Everyone, there's a Wall Street Journal article this week that workers are the happiest they've ever been since the Wall Street Journal study. Do you want to know why they said that? Did you read this article? You want to know the happiest they've ever been?
Why?
It's because they work the least. They don't work at home. They don't work. Everyone, so what I've changed, I'm an optimist, Harry. I know you're an optimist, but I'm a deep optimist, right? I'm a positive sum guy, but I have become zero sum on your average tech worker. I don't think people want to be paid hundreds of thousands of dollars a year to manage large teams and not work. And this is where I sound like a fuddy-duddy, but this is what's broken in venture. It's very hard to do much on a small amount of capital unless you're very careful who you hire. Because everyone needs 6 people to do a tweet, Harry. And every salesperson I know is incredibly grouchy because they have to work harder than 2021. I wrote this post on SaaStr. The sales rep that's making $500,000 a year in 2023 and is miserable. Okay, I wrote it. And you know why? Because he had to work half as hard to make more money in 2021. He's miserable making $500,000 a year in his 20s. Okay, as a sales rep, not as a founder, right? This is toxic. And I know this is a fuddy-duddy thing. I almost think we shouldn't hire any of these people in startups today. You have to have had some adversity or have worked before the boom or you just need to flush through this and have a fresh perspective. Nothing's easy, but it was too easy in the boom. It wasn't easy, but it was too easy. For workers, not just VCs, for humans.
But if I was telling my kids or graduates something, I'd say this is the greatest opportunity ever. It's never been easier to be better than everyone else because everyone else
starting from scratch, yeah, or with the learner's mind. You don't have to literally but from a fresh perspective. I am critical, but it may just be what happens. Too many folks still have like anti-scar tissue from 2021. They want to go back in time. They want to go back when all the leads were handed to them. They want to go back when every startup could grow 100% because demand was inexhaustible. And they're not struggling. They were struggling last year. This year, they're they're not adjusting. Too many people are not adjusting to today's world. That's what's changed. I've given up on a lot of people that I wouldn't have given up on a year ago.
Final quick fire. When will IPO's windows open and why?
It'll be huge in the back half of 24. It'll be huge. The public markets, the multiples have reflated enough. The markets have grown enough. There is plenty of appetite for top tier properties. Okay. We need a Stripe, a Databricks. We need a few iconic ones to get the engine going again. Not ones that IPO at $1 billion or $2 billion. We need a $10 billion plus IPOs that are underpriced, which Bill Gurley hates. So everyone makes money. And Databricks or Stripe IPOs at a high valuation, but it trades up 50%. So everyone's feeling rich. Everyone's feeling smart. Everyone's feeling good. And then I just wrote this up. There is a flood of SaaS companies all north of 200 million growing at higher rates. I've invested in 4 or 5 that are over 200 million. They're just waiting. If the stars aligned, it could have happened now. It's just too fast. First of all, it takes 6 months to IPO. Best case. So you can't IPO tomorrow, right? If you started today, best case would be late Q1, Q2 of next year. Plus it takes longer because of accounting reasons. And you need these leaders to go out. So if it's going to take until early next year for some good ones to go out that you can follow, it's going to be the back half of next year. If things tank or get worse, I think it'll be a good IPO a week at least. A good one that we've heard of in the back half of 2024. And it will feel great. Now, the valuations will not be insane. They'll just be good, right? But it'll be an IPO week in the back half of 24. I'll bet you whatever you want, 5-1, up to a point, that this is right. It'll be an IPO week in the back half of 24.
10 grand?
10. Well, I'll go 10 grand. 1 point. Okay. How much? What do I have to? Yeah, I'll do 10 grand. What did I say? What was the ratio?
You said 5-1.
Oh my God. 10 grand. Well, you did call me on it, right? Yeah. I guess we can do it 5-1.
Dude,
I'll do
I
it.
love you. This was awesome. As always, thank you so much. And I can't honestly say enough how much I loved it.
All right, man. We'll talk in a little bit. Thank you.